Welcome to part one of workman compensation consideration. If you have any questions during the presentation, please type them in the chat window, and if we have time, we'll attempt to answer them live, or if not, we'll answer them by email after the presentation, and if appropriate, share your question that you have with everybody, meaning that it's not personal, it is something that everybody would benefit from the answer. If you have difficulty during the presentation, either type in the chat window if the chat window is still available to you, or call our office at 800-741-4084, and we'll attempt to correct any problems. So let's get started with work comp considerations. Have any of your insureds planned to have an employee get hurt soon? So they call you up and say, I need a policy now because Jane or Joe is planning to get hurt in a couple hours. Obviously, if that happened, we'd want to know about it, and we're having a concern about post-dating coverage to cover these situations. That's not really a concern. In work comp, the concern is they worry about the government makes me do it. This is one of the things that we'll talk about later during the presentation, that work comp, depending on the state you're in, says that you have to have work comp coverage as a part of a state law to do business in that state if you have employees or a certain number of employees. If not, you can be put out of business or fined severely, and the Department of Labor comes and checks the work sites to make sure everybody at the work sites are covered by work compensation coverage when required by the state. So that's the first consideration. This is a mandated coverage that's policed by the government. Remember, when we talk about truckers, we say always blame the government. There are some exceptions to that, and we'll go through those exceptions in a minute. Second thing is the employee gets hurt, so now they're worried about getting sued. This is a one major benefit of a work comp policy covering an injured worker, is that the injured worker cannot sue under tort but must accept the work comp benefits. Again, we'll talk more detail about that. I'm concerned about my employees, so when they get hurt, I want to take care of them. We hope that's most of our insured's attitude. With that attitude, believe it or not, you'll lessen your cost of claims. Major concern when a work comp claim happens is how well that employee gets taken care of by the employer. If they have a good relationship with the employer, who's your insured, then they tend not to go beyond the work comp system and hire lawyers and do other things. So this is a consideration we'll talk about here. But your insured also says, I don't want to pay too much. Have you ever had an insurer tell you, well, that work comp carrier is paying for something they shouldn't do? That injury didn't happen here at our job. The doctor is requiring coverage or treatment beyond what needs to be done. That employee is malingering. They're not coming back to work. Those are things you'll hear. And then you also hear most of the time the injury is a fate. You should have not paid that loss. Again, the verification of when the accident happened. And we'll talk about all these things as we work through this hour work comp consideration presentation. Each state passes laws that addresses employers' obligation to their employee of job-related injuries. So the first concern you have to deal with is all states are different as far as requirement of comp, benefits paid, and even as we say here, and I purposely have the term employee in quotation marks because the states can even vary on the definition of employee. So that's the concern you have to start with. Every state is different. And here's how the states can be different. What employers must have work comp coverage, meaning how many employees, what is employment, what type of insurance carriers can provide coverage. Again, we deal often in the marketplace, and some of you are represented, and some of you have companies that are non-admitted. Later you're going to find that that cannot write work comp coverage. As we said before, what's an employee? Also, who gets tort immunity, meaning who cannot be sued by the injured worker, either as an entity, meaning the corporation, the employer, or people involved in employment, meaning fellow employees, owners of the business, those things. What benefits are payable? The work comp laws of each state define what benefit the injured worker is due, and the insurance carriers are obligated to pay the benefits within the time frame and the amounts or procedure that's required. And then what does work comp cost? Again, that's the audit procedures. So as we look at the state differences, we've got to understand the definition of employer, what type of insurance carrier can provide coverage, what is employee, who gets tort immunity, what benefits are payable, and the audit situation. And we're going to address some of these things in the first hour we have here. We'll address all of them during the 4-hour total CE presentation concerning work comp. Information required by the insurance company. How much information do we, the insurance providers, need and how to get it? Just beyond the numbers. What's the workplace like? Two things we have to look at, because when we look at comp, we're going to start looking at the workplace itself. Where does the motor carrier have employees working? I realize that one of the problems, and we'll talk about that in a few minutes, that a lot of our situations where the employee is away from the workplace, so therefore we can't look at it. But in those cases, CSA will show us the activities on the roadside, meaning are the employees involved in this employer tend to speed, tend to have bad maintenance, tend to be a flatbed, which could cause somebody to fall off. All that can be used as a part of underwriting for work comp CSA, just like it is for underwriting auto liability. Second, Google Earth. This shows you what is at the locations and what can or could hurt the worker at the location, whether it's a garage, whether it's a platform they could fall off on, where they have the vehicles that are parked in that location, and the condition of those. Obviously, Google Earth could not show us all the conditions, but there's a tendency to have maintenance as far as potholes, ice, other kind of things. So we need to think about two things. The workplace in the case of the motor carrier industry has a lot of exposure on the road side, which will be away from the location, and that's the CSA can give us some indication of that. Again, not all, but some. And then Google Earth can show us what is at the location that could create injuries to employees. Second is, what is insured getting paid for? Understanding what's being paid for. No need to know until a loss happens, but at time of loss, they will pay for any and everything and expect everything to be covered. If the employee, independent contractor, and tort immunity would be the considerations that we'll have to deal here. So you got to remember, when a worker gets hurt, they want somebody to pay for those injuries, whether they're employees, an independent contractor, and if not under work comp, can they sue under tort, which requires negligence? We'll talk a little bit more about that. There's no need to understand what makes up the premium until audit time. Work comp premium is not fixed, meaning like property, not even like per vehicle. Work comp is a function of two things to start with. The classification, the work that the employee is doing, and second, the rate per payroll of that worker. One of the problems you have here is that dealing in motor carriers who might be in various states, again, we'll talk about this in more depth as we get through the presentation, there might be more than one state that the rate that the exposure is in, and the insurance company has rights of premiums to that state that might have a variance in the rate from the one that the insured thinks about. So when audit comes, is the insured prepared? You need to look at the classification. You need to look at the definition of remuneration. You need to also address with the work comp carrier, employee versus independent contractors, to make sure there's not a problem there. And you need to see what state rate will apply to the remuneration paid to the employee, and or would the independent contractor be considered an employee in that state or not. One of the concerns that I have had, and some of the expert witness I have done, a couple cases I'm involved in right now, have to do with audits where the auditor changed the classification and or considered independent contractors to be an employee, therefore developing audit premium based on that classification, where the insured did not understand that, and a couple of cases is because the provider of coverage, mainly retail agent, did not do what I felt was the proper job explaining to both the insured and to the provider of coverage these items. The objective in work comp is to cover all employees and provide compensation for work-related injuries and diseases. That's the objective of work comp. It's social medicine. It's designed to protect the worker and pay benefits to benefit society and provide a replacement for the common law tort remedy. And it's called no fault. And there's two parts here. To a placement for common law tort immunity. Common law tort immunity requires a court case, requires the injured worker to prove negligence on behalf of the employer, and therefore any benefits derived would be a judgment made by a jury or a judge concerning those injuries to that worker. By having work comp, the worker cannot sue, but they are provided a defined benefit without having to prove fault, without having to prove negligence. So if the worker gets hurt on the premises or gets hurt during the course of employment for the employer, then no matter if the worker created the injury themselves, meaning they did something stupid, anything short of impairment by drug or alcohol or intentional acts, or in some cases aggressive action, meaning fighting and those kind of things, you would pay the benefit, even though it was injured by the worker for pure stupidity. So the employee loses the right to sue under tort, meaning they cannot sue for $2 million or $10 million or whatever would be there. But they are gained a definitive benefit and recovery. That's the sole remedy without hiring a lawyer. That the remedy, the benefits are guaranteed and policed by the state within the parameters of the state work comp law. And the employer loses the right to defend, meaning you can't say you did it yourself. You can't say that you should have turned this other way. You can't say is that you weren't supposed to be here. It's a job-related injury, so therefore it would have to be paid. But unlike tort, where you don't know what the judgment comes down, the employer knows what their cost is, and that's the work comp premium. And so they don't have to worry about judgments beyond their particular work comp or their insurance coverage or any other consideration. So that's the basics of work comp. It is to protect employees from being injured while they're working or creating a disease while they're working. It's there to benefit society so that we do not have to have a lawyer, that we do not have to have proof tort. It tells the employee a definite benefit, but they cannot sue under tort. It protects the employer from anything beyond the benefit, and as long as it is a job-related injury and there's work comp in place, then the employer is not subject to any other amounts due the injured worker. And again, there are some exceptions. We'll talk about those later, but they're very rare in those cases beyond what they're paying for the premium. So that's the essence of it, to cover all employees and provide compensation for work-related injuries and or diseases. Costs paid by the employer, defined cost. It's an overhead expense. It's an employment expense. If you look at the financial statements, it will be listed as employee benefit or insurance cost. And the employee gets the defined benefit. It's what the employee will receive both for medical treatment, loss of wages, death, and other burial and impairment ratings set by the state laws. Work comp is mandated. It is compulsory. There are a couple exceptions that is where it's elective. 2 states that I'm familiar with. So therefore, when it's elective, the state is not policing that the employer have work comp. That's Texas, and just recently Oklahoma have opted out of comp with other remedies there. There's a couple other states that are considering this, and we have to be aware of this. But most of the states we deal with say the say that you have to have work comp except there are a few states that say if you're an employee and you don't have a certain number of employees, then you don't have to conform. So it's not compulsory unless you have met the number of employees. However, there's no protection under the law. It's down back to tort, meaning just because you do not have to have work comp coverage doesn't mean that the injured worker cannot sue. Some can opt out, meaning individuals, for comp, even though work comp is mandatory. Those are usually limited to officers or owners of the corporation can have those options. The concept here, again, other than the exceptions that we list here, the opt-out states, the numerical numbers you have to have it, and the particularly job-related officers or owners that would not have to have it, then the state makes you comply, and if you do not provide work comp, you're out of business. And if you don't provide work comp and should have work comp, you have no defense as an employer for those job-related injuries. You have to pay, period. So employment is defined by each state. So what is it? Some industry specific in states where domiciled and drivers not an employee. Could the injured occur in states where the work comp makes independent contracts employee? Here's the big difference here. In trucking, and which is one of the state exceptions, the other ones that you find is agriculture, musicians, real estate, and how independent contractors might or might not be considered depending on the industry, construction industry. You'll find that the state says that an independent contractor in one state is not an employee of the motor carrier they're leased to. In another state, it will say that that independent contractor is an employee to the motor carrier they're leased to. So when the injury happens, then the work comp policies would have to respond depending on, or would not have to respond depending on the state definition of employee. There's also states numerically. 7 states say if you have 3 or more employees, you work comp is mandatory, which basically says if you have less than 3, then you do not have to have comp. Some states say less than 4. Some states say less than 5. Other states says 1 or more. Again, you need to check with your state. This is a list of information that I have available to me. This changes periodically. It's not intended here to keep you abreast of the states other than to be aware of this. But the problem is if you don't have work comp because it's not required and you have employees, meaning if your insured who's a motor carrier has work comp, does not have work comp coverage because the state did not make them have work comp coverage, could that employee still be injured? The answer to that question is yes. And could that employee then sue under tort? The answer to that question is yes. So therefore, even though work comp is not, quote, mandatory by unquote, meaning that the employer will not be fined, will not be put out of business for not having work comp, you still would have a concern. I was involved in a case in North Carolina where during the turn down in business, the quote recession, unquote, this insured got rid of vehicles and ended up with only 2. As a part of getting rid of those vehicles, they got rid of all their drivers and also canceled their work comp coverage because now they had fewer than 3 employees. They added a vehicle back onto the policy, which now gave them 3 employees. However, they still, quote, to the retail agent, unquote, could not afford work comp. The retail agent did their job by saying you need work comp. The motor carrier says, well, I can't afford it. I'm not going to buy it. Then an injury happened, and then what happened here is the employee went to a lawyer. The lawyer made a claim under comp, and since there is no coverage under comp, because comp did not exist, and in a minute you're going to see there's no coverage under the auto liability or general liability because of employee exclusion, the motor carrier who should have bought comp now owes for the injuries and has no defense other than the amount that is due. The agent called me up and said, do we need to hire a lawyer to fight the work comp case? And my answer to that agent is, why would you do that? You might need to get a bankruptcy case, but you don't need to get a lawyer to fight the work comp, because if work comp is mandatory, then you have to provide it. If you don't, then you're subject to the payment. The only thing that the lawyer could possibly do is to discuss the numerical amount of injuries that's done. So that's the point here. So even though it's not mandatory, it's not required, the worker or the employee gets hurt, no work comp, who pays the injuries? Their employee exclusion and auto and general liability. So if it's sued under tort, again, you have to prove negligence. Then there is no coverage in the standard policies that we write. So therefore, the company's total assets are exposed. In this case in North Carolina is also unique in that they do not provide protection from the owners of the corporations and make the owners of the corporations personally liable for the injuries to the workers by avoiding the work comp law and not having it. They had to sell their terminal to satisfy this case that was owned personally. So this is the concern that you have. Even though the state does not mandatory work comp coverage, the injured worker can still sue. If they have to prove negligence, so they have to prove tort, but clearly that can be easily done in a lot of cases. And if work comp is mandatory, again, the worker can sue. And if work comp is not provided, then the employer owes the benefit. The difference is if work comp is not required by the state, then the employee would have to prove negligence. If work comp is required by the state and there's no work comp in policy, then the work comp benefits are payable whether there's negligence or not. That's the big difference. But in any case, the employee now sues and therefore sues under tort because there's not work comp, there's not tort immunity. Those suits are then turned over to the liability carriers. The liability carrier says, no, we don't pay that because of our employee exclusion in both auto liability and general liability. So now the company's assets are exposed, meaning the injured worker ends up owning part of or the company that failed to have work comp in place, whether the state requires it or not. Again, there's obviously more exposure if the state requires work comp and you don't have it versus not, because there is a difference between tort, meaning you have to prove, the injured worker would have to prove negligence, and where work comp, there's no negligence that has to be proved. It's an absolute liability for the employer to pay for those injuries. State also difference in compliance. Waiver permitted. There are some employees can decide not to be covered, mainly officers and directors. Some states, even the numerical number says that's an exception in contractors. So you also have how many workers required before coverage is mandated. This is what we're talking about. Coverage for construction workers, domestic farm, owner-operators, and contractors are where there are some exceptions in the state. So again, you need to understand that. My rule is I want everybody covered. We'll talk about that later because I think that's the only way that the employer, who is our insured, the motor carrier, gets proper coverage. Now, who can provide it? There are some state funds. State funds are competitive, and this started when work comp was difficult to get in the 80s, and there's a number of states that have created their own mechanism. The term competitive means that this state-owned insurance company, state funds, compete with the admitted carriers writing work comp in that state. And in those situations, in most states, again, you have to check with your states. You are, as a state agent in that state, are licensed to do business, then you have access to the state fund. There are 3 states that are monopolistic states: Ohio, North Dakota, and Wyoming and Wisconsin, that is not competitive. The only provider of work comp coverage in those states, and they're called monopolistic states, are the state mechanism. So therefore, the only work comp available to protect the employer is by buying it from the state, which 2 factors happen there. The first factor is that it's like unemployment tax. It's just a function of the state collection. The second thing is, and the more important one that I would think, is that a retail agent who's listening to us does not get a commission for those, so that is a consideration too. It can be done by private insurance carriers. Those are the ones that we deal with all the time. Those are the ones that you have access to. Those are the ones that we are owned by individuals or stockholders that provide work comp. There are some states, or most states, will allow self-insurance, either individual, which is very difficult to qualify, and is in most cases not relevant in the trucking arena, because you would have to be qualified for being self-insured in all states that you have an exposure in, which that creates more of a burden than is practical. If you have a location only in one state, then it's not as mechanically hard to do. However, the individual states do require reinsurance, do require state bonds, are still subject to audit and those items, so you'd have to qualify in each state. Again, it's very difficult to do that just because of the balance sheets that motor carriers typically have that would not qualify to be self-insured. The motor carrier could join a group self-insured, and there's a number of self-insured funds around. Florida was the place that most of these funds started in this area, where you have the self-insurance funds, and again, that's where a group of individuals get together and as a group qualify as a self-insured under the state. However, work comp must be provided by the standard companies. They must be admitted insurers in the state where employees have a place of employment. They must be licensed by the state. So when we go back to the list before, in the case of state competitive funds, the case of monopolistic, the case of self-insured, those states are, those mechanisms to provide work comp are limited to the state that has authorized the or who owns the guarantee fund, or who owns the insurance competitive fund, the state monopolistic fund, or the self-insurance qualified is limited to that state. So your employment in that state can be protected by one of those mechanisms, but if that worker makes a claim outside of those states that where the competitive fund, the monopolistic or the self-insured mechanism is domiciled in, then there could be no coverage for those injuries outside of those states. There's also a guarantee fund. Admitted carriers fall in the guarantee fund. Most guarantee funds have a limit for auto liability and general liability and standard work comp that can be collected. Typically, that's $300,000. However, in the state guarantee funds that I'm aware of, the work comp benefit is unlimited, meaning that the work comp, if the insurance provider goes under, the state guarantee funds will provide protection for the employees that were injured that should have been covered by the work comp carrier that has gone under on an unlimited basis, meaning the objective here is to take care of the injured worker irrespective of the guarantee fund caps or the policy limits, because work comp is unlimited. So unlike the guarantee funds for auto liability and general liability, which is typically capped at $300,000, the guarantee funds for work comp for insolvent work comp carriers is unlimited. The state also looks at rates. They file rates. There are two forms of rates. There are fixed rates, where Florida says every insurance carrier has to file these rates, have to use these rates with some exceptions. We'll talk about that in a second. Our second is you have loss cost states where they file a loss cost rate that, again, is determined in both fixed rates and loss cost rates depending on the reporting entity that says there's so much injuries under this classification and you need so much premium to cover the injuries for that classification. The fixed rate then allows automatically things that are added to it, like expense, like profit, like handling the case, where the fixed rate factors in more than just, or supposedly factors in more than just what it costs to pay the claim, where the loss cost states do not do that. So each insurance carrier in loss cost states would then have to file their own rate to be, factors to be added to the loss cost factors. Again, so the big difference here is your rate is fixed rates that everybody uses it, and there's no difference in insurance providers except for the plans. We'll talk about that in a second. That would be available. For the lost cost states, which is the majority of the states, you have to not only compare the insurance carrier, but you have to compare the rates they have filed for those classifications, because those rates could vary. The plans, and we're talking about plans here, will be dividend plans or retrospective plans or retention plans. Deductible plans have to be approved by the state also. And then the state also places services. And if the insurance provider does not properly handle claims, the state can come in and fine the insurance carrier for not properly handling claims within those states. So the state oversight is rates, what plans are available, and what service the insurance carrier would have to provide for injuries within those states, within the laws of the work comp of those states. So monopolistic states, everyone has to join. It's like unemployment taxes. It's a state company. The taxpayers of the states become the guarantee fund. State competitive funds, those are the plans. State starts the insurance company. Typically, it replaced or was addition to the assigned risk. The options to join. Most compete with voluntary markets. The state taxpayers become the guarantee fund, and then but it's only licensed in one state. And you have the assigned risk, the residual market, that's heavily surcharged to protect the assessments in the residual market. Anytime insurance is mandated by the state, work comp, auto liability would be the two that we deal with all the time, then the state has to develop a mechanism so those insureds, employers, or again insureds with autos can purchase insurance no matter how bad they are. This is the assigned risk, the residual markets, the reinsurance funds, depending on what the states are called. They're heavily surcharged. Any deficits in these funds were made up by other insurance carriers who are writing in that state. So the mechanism heavily surcharges these, so there is no deficits involved in it. So those are the residual markets. All right, so we got the monopolistic, competitive, self-insured, or private carriers that can be the provider of coverage. In your situation as a motor carrier, insurer, or agent who's providing insurance to motor carriers, realize that the motor carrier can deal in many states. So therefore, when you choose what mechanisms to provide coverage for your insured, you have to also consider, will there be injuries in other states, and will that work comp carrier, if it's not a private carrier who's licensed in all these states, will they be able to provide benefits and provide tort immunity because they provide benefits to your insured in these other states. So let's talk about the benefits. Again, each state is different. However, all states pay 100% of the necessary medical due to the work-related injury or disease, 100%. So the point here is the injured worker, the employee, has no obligations for any bill that's presented for a job-related injury to a provider of care. The work comp carrier has to pay it. Now, in some states, they allow a managed care situation, which is we are familiar with health insurance, where there's a network that the worker can go to, and the insured or gets a favorable rate because of that. Again, the employee is not subject for the difference. That's a benefit to the employer. And some states have adopted a discount system for provider. Typically, the Social Security Medicare discount rates, where an injured worker walks in, the doctor typically can charge X dollars for the treatment, but because it's work comp, they cannot charge that much. They have to either be a part of the managed care system or apply the discounts that are mandated by the states. Typically, those are the discounts run about 30% in the states that I look at. one of the problems that you have here is that if you're not careful, the injured worker, when they walk in, do not always divulge that this is part of work comp, and you have a bill that's generated, but once it goes to the comp system, then the work comp carrier pays the discounted rate, and the provider must accept that, but sometimes in continuing to bill the worker for those differences, the worker does not owe those things, and as an agent you want to walk through that if it happens, because again that upsets the worker that yes, you got the bill but you don't owe it. Go back to the provider and say you don't have the right to do that because it's work comp and work comp's paying. By the other token, because of the discounts, you're going to have some providing networks, meaning the hospital systems or certain physicians who do not accept work comp because they do not honor the discount. They can't or they won't take work comp because they don't get the full payment. But again, key part here, all states pay for 100% of the necessary medical due to job-related injury, meaning the employer is not, the employee is not subject to any payment made for any job-related injury for medical benefits. The question you always have here is what's necessary, because that's the key part here. And the thing that you'll find out as you walk through this, if you do enough of them, the only expert is the treating physician, meaning we outside here can't say that's not right, it's not due. If the treating physician says it's due, then we owe it. One of the things we can do as an employer or an agent helping our insurance is to have treating physicians that you can send your workers to that accept work comp and understand, that don't understand the necessary treatment, that do not overtreat, and that will release them to work duty because it's available. You can direct the workers there. The worker can choose others, but they go there, and most of the times they will accept that part of it as long as it's paid. They don't go out shopping providers in most cases, but they do have the right to do that. The problem you have is, again, in the cases of motor carriers, is this worker is injured away from a known location, away from their home. So you don't always know, or you don't always have a network provided for those workers there, and so they just go to the emergency room or go to hopefully a walk-in clinic to lessen the cost. And so therefore you have to accept whatever that treating physician says, and that's due. If we feel as an insurance provider there's too much treatment, then we can get a second opinion. And if we get a second opinion and it differs from the first opinion and the first provider does not accept the second opinion, then there is mechanisms where there's a third party, an expert that's there that sorts out the difference between the two. But bottom line is the treating physician says what's due, and we have to pay what the treating physician says. Period. And we must do it until the employee can return to work. There are three elements dealing with return to work. Modified duty, some of you are going to call it light duty, and some providers call it light duty, and even some doctors call it light duty. I use the term modified duty here because I've had a couple cases where the judge said, well, that's not light duty that they're working for, even though it's within the doctor's restrictions. But you want to have work available for this worker when they're released for modified duty, meaning that they can work, but they might not be able to do the job that they did before. Full duty says that they can work without any restrictions, but they're still got treatment, meaning that they have not been released from treatment. Self-treatment is necessary. The physician has not put them at full any duty other than going back to work, but they're still being treated. MMI is the key. MMI stands for Maximum Medical Improvement. This means that they have received all the treatment that the physician can give them. There's no more treatment that they can be provided that will make him any better. So we have to understand those three elements: modified duty, full duty, or MMI. We as a work comp provider of injured to pay for the injured worker's duties, we owe all treatment up until the maximum medical improvement. At that point in time, the insurance carrier has certain rights, depends again on the states, of now closing that claim or getting rid of that obligation to that employee. The second payment besides medical is indemnity. This is payment for lost wages due to job-related injuries. And the first question is how much? There are three factors in how much. When payment starts, then how much can be paid, and then after treatment is over, do we owe the additional for impairment? Again, this varies by states. Each state has a maximum and a minimum. The state maximum is typically changed each year. It's based on the average wage in that state. And what happens here is no matter what an injured worker makes, the max they can collect is the state max. There is a minimum too, but I will discuss the minimum in this case because our drivers, our employees for motor carriers will always be making more, in most cases that I'm ever aware of, more than the minimum. So we're talking about the maximum. The typical maximum today, again, it varies by state. By the way, Iowa has the highest one, is somewhere between $900 and $1,000 a week. So no matter what they make, the worker would only get paid that maximum. Now, what does the maximum is? It's typically 66 2/3 of their average weekly rate. Why 66 2/3? Because it's not taxable. And what's their average weekly wage? It's based on the last 3 months, the last 91 days of work. And your insurers would be required to provide their work comp carrier and provide the state, if questioned by how much is being paid, evidence of what that worker made for the last 3 months or 91 days. It varies slightly in those words here. So that's a consideration. So again, why 66 2/3? Because that's a taxable pay. The work comp premium is not taxable, and there's no Social Security taken out of it, there's no FICA taken out of it, there's no state unemployment FUTA taken out of it, or SUTA taken out of it. It's net pay. So this is why you have the factor. What we have a concern here is short-time employees, employees who had not worked for our motor carrier for the 91 days or 3 months. There's a couple of states that go beyond the 91 days and 3 months, but that's the typical here. So then how do you develop that? Well, then you get similar employees that did work in those areas. But of course, in a lot of cases, what's a similar employee? Because in most of the time in the motor carriers for driver injuries, we pay on what is commonly called piecework, and that is because it's production of what they produce as a function of the revenue they generate to the employer. And as we all know, some workers work harder than others. So how do you get a similar one? There's also could be no consistency in earning, particularly if you are insured or involved in some industries like fresh fruit and vegetables or ones that vary by season on hauling. And so sometimes during the month or even during the period of time, the driver makes more than others. So it's always difficult to figure what the average weekly wage is when we have non-hourly rate with workers who are working in a location and working 8 hours a day, 40 hours a week. That's easy. But anything else short of that, it becomes difficult to figure. So first thing you have to consider is the average weekly wage and how to properly figure it. One of the things that I suggest for you as a retail agent is to get involved with your insured when that request here is and work through that, because this is one area that the injured worker gets upset because they're not getting collected enough. They go retain a lawyer, and that's one of the ways the lawyers attack the benefit and the provider of coverage to say you did not pay enough. And most states say if the lawyer can create a benefit, then they get a fee. If there's no benefit the lawyer finds, then there's no fees. So this is one way to attack. So you need to figure this out or help your insured doing that. Sometimes it can fall back to the worker's own financial statement or tax returns, excuse me, not financial statement, but tax returns. So you need to work that out. But all they get paid is 66 2/3. After they establish weekly wage, when can they collect it? Some states say you start paying indemnity for 3 days. After 3 days, some states say you do not get indemnity and payment until after 7 days. So after work, if you're off work for more than 2 weeks, then you collect the period that you did not pay. So it's not always immediately that they collect this, and again, states can vary by those 4 days. Then the insurance carrier has up to 2 weeks to make the payment that's due. So the problem here is you got workers who live hand to mouth. How many of the workers you have, how many of the drivers you have, how many of the workers you have involved as a motor carrier where that driver can go 3 weeks without pay? One of the suggestions we have, again, to control work comp costs, is to have some means where these drivers get some compensation during this period of time before work comp kicks in. This would be for short-term disability. It helps keep drivers away. It also later helps with your experience mod, because now the employer is paying for these things, not the insurance carrier, for this period of time. And later, the next hours, we're going to talk about the experience mod and how to control that. But again, you need to talk to your insured, because you want to keep, if it's a good worker, and the injury will allow them to come back to work, and your employer and your insured, the motor carrier, wants them back to work to keep it favorably there. You want to try to keep them on payroll. If it goes beyond the 2 weeks, then the work comp carrier can pick up and pay those things. You also need to know that you don't have to pay the wage that they typically got before. You can pay, again, the 66 2/3, which is all that's owed. But you need to work that out. It helps to keep lawyers away. It helps to keep a worker who will return to work soon back within the workforce, and it also helps experience bond. We have these terms. Temporary means that they'll be paid until they can get back to work. Permanent means that that's lifetime, therefore they will not come back to work. Total means they're completely off of work, and partial means they can work some. So you'll look at total permanent, that's when they won't get better and will come back to work. You put partial temporary, then they can work light duty, but they cannot do full duty. And then you have the total, partial permanent. Again, they can do some work, but not the work they used to do. So these are the terminologies that you'll be dealing with to determine what's paid and when. How long a medical's injury paid? As long as they're off work, as long as the doctor keeps them off work. Once they're released to modified duty, light duty, then what happens is the employer pays part of it, and what the employer does not pay up to the average weekly wage, the insurance company will owe. Once they reach maximum medical improvement, MMI, then there's no longer any indemnity owed. So the key part here is to get them back to work as soon as possible, to provide employment even though they are not released to full duty or not released to MMI. But after MMI, then the work is over. One of the problems you have in motor carriers is that you don't always have ability for modified duty, because typically, for typically smaller motor carriers, the only work you have available is to be a truck driver, and sometimes that is not able to be released for those things. But these are the terms you have. So the objective is to give them some work, to get them back off of the couch, out of the bed, to do some work. In those cases, the employer and the work comp carrier work together to still make sure them having the average weekly wage, and then you want to reach the maximum medical improvement, therefore you don't owe any indemnity anymore. Medical improvement. No more medical treatment can be made to the worker. The key generally is to get the worker to maximum improvement. The worker is capable to perform the work as they did prior to the injury. That's the thing. If they cannot do the same work, then they have an impairment rating, and then you would owe more than the indemnity that you've paid already to take care of a payment made because of not being able to work or have the same ability to work as you did before the injuries. This is the impairment rating. It's also some states that pay for loss of body parts. These are the dollars that are paid over and above indemnity. A lot of states call this washout, meaning what you would owe at this point in time is a lump sum dollars to take care of all their future injuries or their inability to work. Typically, the states have a formula that says what is owed for impairment. Most of the states refer to Minnesota by rating mechanism, by the way, just as an understanding of that. But that's what you pay. You pay indemnity up until maximum medical improvement if they're not working. If they're working, then you still owe average weekly wage that be paid by the insurance carrier and or the employer. That once you reach maximum medical improvement, then you don't owe any more indemnity, but you would possibly owe, or the insured, the employer, the employee would have a benefit based on how much their impairment is, their loss of body functions, or the loss of body parts over and above that. And then there would be a lump sum washout settlement that you would have everybody sign off of that says the case is closed. That's what we're looking at, MMI, the impairment rating, and any washout to close the case. Burial also varies by state, between $500 and $5,000 to $7,500. Again, a small amount. But the real difference is the death benefits. First off, you got to realize the death benefits in work comp is not life insurance. It's payments to dependents to replace support provided by the deceased employees, meaning that if the employee has no dependents, then the work comp mechanism owes no death benefits. There's a couple options that I found in a couple states that say you owe into some state funds, but that is rare. I think Iowa's one that has that. I've had a couple of cases. We had a 22-year-old who lived on their own, had no spouse, had no children, parents were not dependent on them, who unfortunately died. Therefore, we owed no death benefits. I've had another older worker, 68 years old, again, no spouse, no children, again, no family members who were dependent on them, that unfortunately died because of job-related injury, and we owed no death benefits. So that's the key here. It's not life insurance. It's death benefits to replace for dependents to replace what that deceased worker provided for those dependents. Then who is due the death benefit? It must be an dependent. Again, that can vary by states. Most states say that a children obviously are dependent. Some states say other family members, which could be mothers and fathers, depending on the age, are dependent. And some states say that the mothers of the children, if they're not married to the worker, is not a dependent. So that would be varying. Then the states say how much. The key here is this is where the states differ the greatest. Florida, for example, is $150,000, no matter what you make. Other states have more than that, and it's a function of the average weekly wage, and then they factor in a time frame. So one of the things that can vary by state more than other is the death benefits. This is the major deal. So the two variances are the impairment rating, the washout, and the death benefits. So motor carriers can have workers in different states. Workers could have options for which state law they can collect under. So which state rate will apply? It depends on the one that pays the most. If the worker has a job-related injury, whether insured worker, is the most. So the key here is if the worker gets injury, will the state work comp policy respond to that injury? Will they meet the requirements of the state laws of that state? And that depends on how the policy is set up. We'll talk about that in a later section. But can the worker claim? It will depend on the extraterritorial provisions of the individual state laws. Typically, the states say that the injured worker can make a claim under the state laws of the place they were hired, the place they were employed, the state they were injured in, or the state they reside in. They usually have, in most cases, those four options. For example, when I was in college, I allowed, my father had me periodically rent a hotel room that advertised in the paper for truck drivers to work for his Florida company. I went to college in North Carolina. These workers would come in. I would screen them as far as their job. I would tell them what was offered, and that could be considered a place of hire. But then I would send them down to Florida to be processed. So that's the place of employment. But as they were now working out of Florida, they could be injured in Georgia, and they could live in South Carolina. So in those cases, they were hired in Winston-Salem, North Carolina. They worked out of Florida. They were injured in Georgia, but they lived in South Carolina. So that would give them 4 options here. So most states, most employee workers, most employees have those options. So what state can the worker want to receive benefits from? Obviously, it's the one that pays the most. So let's talk about that. All states pay medical, 100%. So they won't vary in medical. There's no benefit to shop states based on medical. Indemnity, again, because of the wages of drivers, and now even the wages going up, even the $50,000 or $60,000 level. If you take 66 2/3 of those numbers, it's still going to be below the state maximum. So in all states right now, with the driver wages, which would be less than $75,000, the 66 2/3 would bring it down to less than the state maximum, which would be $50,000 or $52,000 a year. So therefore, the state maximum would the driver's average weekly wage would not exceed the state maximum. So there'd be no benefit to shop state based on indemnity. Where there's a benefit, again, is the impairment rating or death benefits, where I had a case in Florida where the worker got injured in North Carolina, and they chose to attempt to collect the death benefits out of North Carolina because that's where they're injured, because North Carolina paid a couple $100,000 more than Florida did. Again, impairment ratings. I had an injury in Florida, and in Florida, impairment rating was very small as a comparison to that because of losing of body function, but they argued that they were hired in Oklahoma, and Oklahoma had benefits for loss of arms or eyes or things like that that paid more. So the place that you shop is death benefits and or impairment, where they're hurt severely and can't get back to work, which is not going to be a lot of the cases that you'll be dealing with. So in motor carriers, how many states the worker can claim? As you set the policy up, we'll talk about that later. The use of non-employees, owner-operators, what the state law allows. Again, we'll talk about these later. How many employees before work comp is mandatory? Again, you got to realize that even though it's not mandatory, you still might have an obligation. If it's mandatory, you have no defenses. If employee owner-operator gets injured, is there other coverages? Must be under tort, meaning you have to sue for liability. You have to sue and prove negligent. The employee gets no, the employer gets no coverage in the auto liability or general liability because of the employee exclusion. Because they're employee, there's no coverage in auto or general liability because of employee exclusion. The owner operator might get coverage under work comp, auto liability, or general liability because they're not an employee, again, depending on the state definition, or there could be no coverage. In the case of no coverage for work comp, tort immunity, or no coverage under auto liability and general liability, then the injured worker could end up owning the company or part of the company and have to be paid out of the assets of the insured, or unfortunately sometimes the assets of the retail agent. Insurance motor carriers, again, they work away from home. The injuries are hard to verify. Medical treatment is hard to control. However, if they're injured, and I had a case where a driver fell in a truck stop, you could establish subrogation if someone else caused those injuries. However, again, it's hard to establish because you don't have someone there to immediately look at the site. Those are the things that have to deal with the first hour of the work comp. We will be giving in more detail with the policies set up and the question of owner operators and audits as we go forward. So we look forward to you continuing this process. Remember, this is the first hour. To complete the CE, you must attend all 4 hours of the session. Thank you for your time and attention. We look forward to seeing you in the future presentations.